The Federal Reserve made a small mistake by raising interest rates again on Wednesday, one it apparently plans to compound, over and over again, until the folly of its ways becomes clear. As everyone knows, the U.S. Central Bank raised the federal funds rate by 0.25 percentage point, to a target range of 1.5% to 1.75%. The Fed's statement and accompanying forecast point to a perception that the economy is accelerating and that a boost in inflation is imminent. But it's not true. And by planning to boost rates 2 more times this year and 3 times next year, the Fed can do real damage to housing markets, consumers, and, most importantly, the standard of living of middle-class workers who have been left behind by the booms in upper-end incomes, net worth and financial markets for the last 45 years. Liberating the middle class from stagnation is the work former Fed Chairwoman Janet Yellen, and her predecessor Ben Bernanke, to some degree, began by forcing interest rates to near zero amid 2008's financial crisis and then, significantly, keeping them there long after politicians began bleating about the integrity of the dollar and the end of the world. The economic outlook has strengthened in recent months, Fed Chairman Jerome Powell said after his first meeting at the head of the Fed's conference table. Several factors are supporting the outlook. Fiscal policy has become more stimulative, ongoing job gains are boosting incomes and confidence, foreign growth is on a firm trajectory, and overall financial conditions remain accommodative. Let's review just how true that set of sentiments is. Growth is accelerating. No, it's not. Much has been made of the fact that job growth has picked up the last 2 months, but nothing about 2017 growth was extraordinary. Not and jobs are gross domestic product. And there are few signs that 2018 is much different. For all the conventional wisdom about acceleration that has taken root on Wall Street, the economy added 2.28 million jobs in the 12 months ending in February. That's down from 2.5 million during Barack Obama's last 12 months in office, ending January 2017, and 2.71 million in full year 2015. Even the Fed, which should know better, is overreacting to the 552,000 new jobs reported in the last 2 months, implicitly assuming President Donald Trump's tax cut and spending increases will drive bigger gains. It's just as likely, though, that big gains in retailing, think Walmart and Amazon.com, and construction during their slow seasons point to seasonal adjustment flubs by number crunchers, or that this 2-month surge will last as long as the 608,000 job 2-month gain in mid-2015 or the 615,000 job surge that fall, each of which preceded a reversion to the mean. There is simply no acceleration in job creation, a remarkable mistake for a central bank to make. There's only a lower unemployment rate, 4.1% now, versus 5.7% in early 2015. That's to be expected given the steady, unspectacular march of jobs growth since 2010. It was one point of the exercise. The other was real wage growth. The same is true of growth. The economy grew 2.3% in Trump's first year in office, better than 2016, but slower than 2014 or 2015. Yet the Fed's forecast is that growth will pick up to 2.7% this year. But 2.7%, if it even happens, is nothing scary. It's just bumping around near the high end of recent ranges and below 2015. I'd not voted against the tax cuts and most spending hikes last fall, in a bid to keep growth in its Goldilocks zone of 2.3 to 2.5%, but the difference isn't much. Read. Powell would sooner dismiss his colleagues than Trump's tax cuts. What is decelerating since 2015 is real income growth for middle-income workers, and living standards with them, and that is a huge deal, which persistent rate hikes are likely to make worse. A total of 3 rate hikes this year would add $6 billion to consumers' credit card payments, says Thomas Donaldson, an analyst at Compare Cards. Presumably, 3 more next year would make it $12 billion. Mortgage broker LendingTree, minus 3.05% warns that higher mortgage rates will hurt housing affordability and make people less willing to move, giving up their low mortgage rate on their current home for a higher one on a new house. All this so the Fed can transfer wealth to the bond market, protecting owners of 10-year treasuries. TMU's 10Y, minus 1.37% from barely their inflation. After all, shareholders got a huge corporate tax cut to incentivize stock buybacks, stoking the Dow Jones Industrial Average. Dow Jones Industrial Average, minus 1.25% and S&P 500 SPX, minus 1.11%, and equities shouldn't have all the fun. Here's your periodic reminder that the Fed's target inflation measure hasn't risen more than 2.2% in any year since 1993. That's a rounding error above the Fed's 2% target, more than compensated for by the decade spent at 1.8% annually, or below. There's no inflation, and it's not coming fast, if it's coming at all. And even that assumes that the growth party, such as it is, won't be queered by a president who plans to announce tariffs on China on Thursday. The Fed should realize that low inflation gives it a chance to score an historic achievement, reversing 45 years of wage stagnation, by running a near full employment economy that has been both a huge long-term growth retardant and a massive injustice. Weighed against minimal inflation risks, this shouldn't even be a decision. This was the point, one point anyway, of Yellen's time at the Fed. It's vital, even historic, for the Fed to weigh in heavily for the fortunes of the middle class, not least because fiscal policy is in the hands of a big, fat idiot. Now read, Fed hawks and doves send different signals on rates and inflation, but doves rule roost.